Welcome to Yield Nerd, an educational show about how you can acquire and manage yield. All right, Yield Nerds, I thought I would take a very different topic and talk about it today, and this is IRAs and yield investing. People usually don't put them in the same sentence. Most people say my IRA is my growth side of the house, and my fixed income portfolio is my income side of the house. So I thought I would dive deeper into how I'm thinking about it. But as always, I'd like to remind you that there is a playlist, and all of these episodes are in sequential order there. You might want to use that instead of picking something right from the middle. My usual disclaimers: I am not a wealth management advisor. This is not investment advice or tax advice. I do not have sponsors. I don't have merchandise to sell. I am not about product or politics. I learn every day, including when you email me or ask me questions or make comments, and I'm sharing my education. You do you. Well, let's talk about the agenda. We're going to talk about IRAs and the amazing growth engine it is, and how people become millionaires by just throwing money at the IRA and watching it grow. How awesome, pardon my sarcasm. And then we'll look at what's happening in the bond market, and I'll tell you my mindset on IRAs and what I'm doing with my IRA, and we'll see where we go next. Hey, you may remember this is from a much earlier episode, and I posted a link to that right there. We talk about the philosophy of growth investing and how growth investing is like a lobster. And if you haven't watched that, take a minute, watch that short, and come right back here. And if you've watched it, the IRA investor is kind of a growth investor. They say, I'm not ready to retire yet. I have a nest egg. I'm going to grow, and it is going to become enormous. And tax breaks don't mean a thing, so I don't really need to worry about tax breaks. It is all about growth. And so I'm just going to buy the riskiest stocks, say a prayer, sit on it for 20 years, and you are welcome to call me genius. And that is what an IRA investor thinks. And power to them, many of them have become millionaires like that, and that's awesome. So I wanted to introduce you to a company. We're going to call this the Magic Beans Company. The Magic Beans Company is one where, they are a growth stock is what I understand. The stock trades at 10x revenues and they sell magic beans. And wanted to pause there and say, is there a problem here with a company trading at 10 times revenues? Maybe you don't have a problem yet. Allow me to explain. So Magic Beans Company, if it truly was giving or trading at 10x revenues, if you wanted your money back in 10 years, meaning if it was a 10-year treasury and you wanted your money back, mind you, this is not even giving a return. If you bought a company at 10 times revenue, trading at 10 times revenue, the company will have to pay you 100% of their revenue in dividends. Sounds like a pretty interesting deal. The CEO will need to go and talk to the board and say, hey, by the way, can we take every dollar in the top line and give it away as dividends? Because, we got to pay the money back for our investors. And, oh, wait a second, in order to make this software, in order to make our goods, we had some cost of goods. We had to buy raw material, we had to run these things in a chip form. Minor thing, to truly pay back in 10 years, I also need to have $0 in cost of goods sold. Can't really do that even in a software company, because it needs electricity, it needs servers, it needs, fixed costs. Oh, one more thing. I also can't pay my employees any salaries because, I'm paying every dollar of my top line. And if I have thousands of employees, can't do that as well. And remember, this is a real company, and I'm going to tell you who it is. Oh, one more thing. The company can't pay taxes. I'm sorry. Because if the company paid taxes, it can't give you all of its revenues as dividends for the next 10 years, because that's what you paid for the stock. Wait, one more thing. When you get your dividends are taxable, but once you take away the tax from your dividends, you don't get your money back in 10 years. So we're going to assume you also don't pay taxes on your dividends. And oh, well, I also can't invest in R&D for the next 10 years because I got to keep my revenue run rate so I can pay you the dividend for the next 10 years so you can get your money back in 10 years. And so, would you like to buy this growth stock at whatever price it is? Does that sound stupid? Let me save you the trouble. That is a real company. That is a company that traded at 10 times revenue. And guess which company it is? It was a favorite of many IRAs. Some of you, going back, if you had IRAs 20 years ago, you probably had this in your portfolio. It was loved by pension funds because this is the Magic Beans Company. The quote is by Scott McNeely. He truly said the words in the previous page. And he said, "Do you think I'm a magician? Why is my company valued at 10 times revenue?" And the company is Sun Microsystems. Guess what happened when the emperor was called naked? That is what happened to their stock. It was acquired by Oracle several years later. The point I'm trying to make here is trading at 10 times revenue and you are chasing that company because your IRA is all growth. What a joke. By the way, I thought I would save you the misery. Here is the total market cap of companies today in the market whose price to sales ratio is more than 10. Are you ready to see how much of it is happening? When Scott McNeely gave that infamous speech, the total market cap of companies that were trading at price to sales greater than 10x was 6 trillion. Ta-da! This is where we are in 2021, and 2023 is higher than 2021. The Rise of the Reckless is the name of this article. I'm not saying you should or should not buy growth stocks. I'm just telling you why I am not. Let's look at the bond market in the meanwhile. Oh, by the way, short-term yields are up 63% over where they were a year ago. We are at a 20-plus year high on interest rates, and it looks like rates may go up even more. They may stay high for a longer period. The 10-year Treasury is at a 30-year high, and I don't know that we're all going to jump and buy 10-year Treasuries. We may add duration, but it doesn't mean we're buying 10 years. And for now, short term looks pretty good to me. So what is my conclusion on IRAs? Even if I had the IRA, which I do, and even if I had spare change in that, which I do, my assessment is that there is a pretty good odds of a government shutdown pretty soon. Demands for treasuries are lower when supply needs to be higher, so the treasury yield is going to be even higher. I don't sit here and think about tax break, no tax break. If stocks are likely to go down because there is the rise of the reckless, and I can get really good yield, what would a yield nerd do with an IRA? Let me tell you what I am doing. And I'd like to think I'm a very, very good looking bottom feeder. That is what I am. And I've got these whiskers that look for signals of companies I can pick up that I would call a fallen angel. Let me explain what I mean. Here is my filter, and I apologize, I should give credit to Schwab.com. This screenshot is from Schwab. I do not endorse them. I don't get royalty from them. It's just that I want to give credit to where this picture came from. So here is what I do. I look for companies whose current stock price is less than or equal to 5% of their 52-week low, meaning they are at a 52-week low as of now or pretty close to it. They have a pretty high volume, so when I want to sell, I can sell. Their dividend coverage ratio is pretty high. Ideally, I'd like to have no debt, but there are fewer and fewer companies with no debt. So I say, okay, I'll take a debt to equity ratio less than 1. I would like as much cash flow as possible. So I kind of look at their cash flow. And I'd like to see who pays dividends, and I would like a low PE ratio. So let's see who comes up. Here is that same list, the result of that sorted by cash flow. In case you forgot, cash flow is EBIAT plus DA. It's earnings before interest and taxes. However, you add back depreciation and amortization. So you take out the non-cash funny money expense and you say, who has a lot of money sitting on their hands? But then it's a myth to think that Northrop Grumman is swimming in cash because their debt to equity ratio is insanely high. Even though their earnings before interest is very high, a good chunk of their earnings goes towards paying off their debt, which is why their dividend is 1.71%. If they did not have that kind of debt, that would be an incredible company with huge cash flows that is also only trading at 3% above its 52-week low. I'm just using that as an example. I don't care what stock you buy. But this, if you only care about cash flow, you would look at that. What if you only care about buying the cheapest stock at the lowest PE ratio? Let me show you what happens. Here is a company, Zing, which they claim their dividend is 137%. Let me save you the suspense. They don't have the money to pay it. Their coverage ratio is 76%, which means they can't even cover their dividends. They have high debt. But if you wanted to only buy cheap stock, presumably you would look in this area. What if indeed you said, well, I want a company that's debt-free. Here are debt-free companies, and if you only focused on debt, you would look at companies like Richardson Electronics, Sturman, Ruger, Sega, and so on. The challenge is they may be debt-free, but they don't have a lot of cash flow per share. So the real way to think about it is, and oh, by the way, here is Sega Technologies, they can't even cover their dividend. So the real thing is a combination of the two, income and value. Let me tell you more. I only filter by US stock because I don't like the volatility and the exchange rate risk. And I look for high volume. I look for a healthy dividend. And I obviously want a high coverage ratio. I don't like to pay high PE ratios. And I'd love to go for zero debt or as close to it. And I'd like a lot of cash flow per share. If you have a company that has high cash flow per share and low or no debt, that is a winner because they are generating a lot of cash, EBIAT plus DA, and they don't have interest to pay. That means they will be able to afford high dividends. Guess who shows up in that? These companies, except I apply one more filter because I'm not good enough with just high cash flow. I want high cash flow and low or no debt. The company with no debt and the highest cash flow, I don't mean to plug Cal-Maine Foods, full disclosure, I own Cal-Maine Foods. There is a company that generates a lot of cash per share, no debt, and they can cover their dividend 3 times over, and they pay a cool 10% in qualified dividends. You do you. I just want to declare my conflict of interest. So this is the screener that I use. I sit there and patiently watch to see if there are any growth companies, IT companies that show up. And as you can see, it's energy, energy, energy all over the place with 1 or 2 exceptions. I'm a very patient investor. I don't buy IT because it's cool. I buy it if it is a good deal. And so I'd like to think of myself as somebody who sits there waiting for falling nickels, fallen angels, dollars. But my thought for the next 60 to 90 days is that shutdowns usually do not rock the equity market, but I expect one later this year. And on or around December 1st, I'll be sitting in cash. If there are equities with incredible values, I might buy one now. Otherwise, I just sit on cash. Even in an IRA, I do not buy growth stocks as the traditional definition is. I actually buy short-term treasuries even in my IRA and wait for the market to crumble so I can be the good guy buying those value stocks. You do you. Questions, comments, Badri, yieldnerd@gmail.com. Thank you. Thank you for listening to Yield Nerd, a do-it-yourself show for yield accumulation and management.